Assalamualaikum warahmatullahi wabarakatuh. Hello everyone, I am Desilia Utami with NPM 2441201 from Accounting Class 24A. On this occasion, I will explain about monetary system, which is one of the assessment in the introduction to macroeconomic course. Here is the explanation. Enjoy watching, guys. Understanding the amount of money in circulation. Money supply, often abbreviated as M, is the total value of money available and used in economy at a certain time. It includes all forms of money that are easily used for everyday transaction. The main components of money supply, like C or currency, is cash held directly by the general public, such as banknotes and coins. And then D or deposits is money stored in checking or savings accounts at banks that can be used for transaction. Basic formula: M is C plus D. So, the money supply is the sum of cash circulating in the community and deposits held in banks. Who determines the money supply? First, central bank. It controls money supply through monetary policy such as open market operation, interest rates, and reserve requirements. And two, households or publics is decide how much cash they keep compared to money in banks. And last, three, commercial banks is through their reserve system determine how much deposits must be held as reserves and how much can be loaned out. Next, bank reserve system. Bank manage public funds deposit in the form of deposits. There are two main systems for storing and using these funds. A 100% reserve system. Banks keep all funds deposited by customers as reserves. No new money is created from lending activity. And B. Fractional reserve banking. Banks only keep a small portion of funds as a reserve, for example, 20%, and lend out the rest to others. And in this way, banks create new money in the economy because the loans given are again deposited in other banks as deposits. And then how central banks control the money supply? To fit as an example, 1. Open market operation. Buying government bonds like increase money supply. Selling government bonds like decrease money supply. And 2. Reserve requirements. Determines the percentage of deposit that must be held as reserve. Increasing double R, decrease money supply, and vice versa. And 3. Discount rate. The interest rate charged by the central bank for loans to commercial banks. Encouraging this rate makes borrowing more expensive, like decreases money supply. Money demand and stability. Money demand can change drastically because of developing financial technology, such as e-wallets, credit card. And next, number 2, new financial products. 3. Change in public preference for liquidity. Example, since 1993, the Federal Reserve, the U.S. Central Bank, no longer relies on M1 or M2 as the main indicators because these data no longer accurately reflect economic pressures. And next, important terms. A. High-powered money is the monetary base that includes currency in circulation and banks reserve, which can be multiplied into a larger money supply. B. Excess reserve. Yes, bank reserve above the required minimum amount. C. Open market operation. Yes, activities of buying and selling securities by the central bank to control the money supply. And D. Money multiplier. The ratio that shows how many times the monetary base can expand the total money supply. And large A. Fractional reserve banking is a system in which banks keep only a small fraction of deposits as reserve. That's all the explanation from me. I hope it can be understood and be useful for all of you. Thank you. See you in the next video, guys. Bye bye.